Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, this week we've had a lot of attempted breakouts and reversals in markets, which have been really interesting. And some of these breakouts have actually failed and it looks like they're trying to build up momentum. So if we just start with commodities. Now, commodities generally, we're seeing higher prices on commodities, and that's largely being driven by the weak dollar. Now, if you look at the dollar against any currency, but if you look at the dollar index, which is a measure of the strength of the dollar versus a basket of currencies around the world, you will see that it's been hitting lows since May, June. So it's starting to weaken. And a weak dollar is usually positive for commodities because they are priced in dollars. Now, if you look at gold, for example, we've had a nearly 9-year high on gold. So we're at $1,853 per ounce. And it looks like the gold price is trying to break higher. And if it gets above that 1,850 level, then we could be pushing on towards the $2,000 level. So it'll be interesting to watch. But gold's bedfellow, the other precious metal out there that we often see and talk about, is silver. Now, silver has broken out to a 6-year high, and that is around $22 per ounce. Now, silver is more volatile than gold, and I mean, gold is volatile enough. So if you invest in silver, you usually will expect the price moves to be sort of 2 or 3 times that of gold. So it means that you can see some quite quick rallies and then some severe pullbacks. So if you invest in silver, you have to be ready to experience that. And the silver price has rallied on part because obviously there is some correlation historically with gold and because of the demand for precious metals and the fall in the value of the US dollar. But it's also because we've seen a lot of bets, a lot of government stimulus being placed on clean campaigns. So some of that might be clean energy, for example. So there's been around about £50 billion worth of stimulus packages already promised by governments around the world in relation to trying to drive their economies, but in a green way. And if you think about it, silver has a lot of industrial uses, more so than gold. And in particular, if you think about solar energy, it's used in the building of solar panels. So we could be in a bit of a sweet spot for silver at the moment. Now, if we move away from commodities now, we look at the bond market. The 10-year US Treasury yield has broken down below the 0.6% level. In fact, it's about 0.589. Now, the 0.6 level is quite key because it could be a sign that the yields are about to break even lower. So if you remember, when Treasury yields break lower, that means their price goes higher. So there is a demand for Treasuries, so it's a haven. And that's because there is still fear over the state of the US economy, particularly after Donald Trump said that it was going to be, the coronavirus was going to get worse before it gets better. And also, it's worth bearing in mind the summer months have historically been very good for US Treasuries. And it's not surprising, therefore, that the 10-year UK gilt has broken lower as well. The yield on that has broken lower. It's now down to around about 0.129. So holding government bonds has been a very profitable trade once again. And this is a continuation of that bull market in US Treasuries, but we're also seeing it in UK gilt as the bond markets, or particularly the government bonds, are not buying what the equity markets are selling in terms of their optimism about the recovery from the coronavirus. So it will be interesting to see whether that breakout in bond markets will be sustained, and we will see the price of government bonds continue to push higher. Now, if we look at equity markets, the S&P 500 attempted to break higher. It's been stuck between that 3,250 range and 2,950, and it's been a box where it's been for the last month or so. Every time it gets towards the top end of that range, it then sells off. When it gets to the bottom end of that range, it then tends to rebound and rally. Now, what we've seen is the market tried to break higher this week, and it actually got up to around about 3,270, but then pulled back. Can the market finally push higher? It's trying to break higher up towards that sort of 3,300 level, then hopefully onto the all-time highs that we experienced back in February, but it's struggling to do so. Equally, on the Ftse 100, we saw the Ftse 100 break up towards the 6,300 level, but then failed. Now, the optimism followed the announcement of a £750 billion bailout fund that was agreed by the European Union. So that was obviously a positive for the European economy going forward. But of course, again, worries about this second wave of the coronavirus reared its head and the market started to pull back. But what we've also seen is some interesting rotations, or quite aggressive rotations in the last week. Now, we've seen the technology stocks, which have been pushing the market higher, which have been the leaders. And obviously, if you look back to America, the NASDAQ composite has been hitting new all-time highs, while the S&P 500 hasn't yet achieved that. But what we saw is we've seen some rotations from those tech stocks into some of the financials. Now, give you an example, we saw the price of Amazon fall by more than 7% last week, while at the same time some of the cyclical sectors like financial started to rally. And it was unusual to see a week where tech stocks had a poor week, a negative week, and actually the wider S&P 500 had a positive week. We hadn't seen that for a very long time. So it's very interesting to see the narrative in the headlines started to become panic over tech stocks collapsing, while the wider cyclicals were actually starting to rally. So that rotation. But then on Monday this week, we saw the rotation reverse. In fact, we saw Amazon's share price jump 7% in one day. It wasn't just Amazon. If you start to look at Tesla, I think their share price rallied more than 9% at one point on Monday. And if you looked at tech stocks over in China, we saw the reversal of the previous week change and we saw them rally. And it meant that all the cyclical sectors unraveled. And so if you looked at the Dow Jones in America, you would have seen that was the laggard at the start of this week. But again, as we got through Tuesday, we started to see some of those trends reverse slightly again. So we're seeing a lot of rotation back and forth from tech stocks to cyclicals back to tech stocks. But as it stands currently, the tech stocks are still leading the charge in the market. So we'd want to see whether those rotations are going to be sustainable. But interestingly, we also saw some of the geographical rotations take hold. So we saw US stocks start to lag behind European and UK stocks. But then again, that pattern is starting to reverse in the last sort of 24, 48 hours. So there's a lot of volatility in markets, particularly in the tech sector, which is something that's very interesting that I'll probably come on to again at a future date. What it means that investing in tech is becoming very tricky. So we're seeing big swings day to day, which weren't apparent in the last month or two, or certainly since the rebound from the lows of March. But the VIX, the fear index, which is obviously based on a measure of volatility in S&P 500, has fallen below its 200-day moving average. So it would suggest the level of fear is falling in equity markets. And you can see the level of greed is actually accelerating. If you look at the CNN Fear and Greed Index, we've seen almost a breakout in greed in the last week. And it's back towards the levels that we saw in February before the market collapsed. So the fear is receding, but the greed is obviously increasing. But we are still seeing some volatility, some pickups in volatility in particular areas of the market. And those are areas which the Robinhood traders that I've talked about obviously like. So if that continues, it'll be interesting to see whether that has wider implications for the general indices. So we actually start to see the wider market start to become more volatile as people become spooked over the volatility we see in tech stocks. Interestingly, it's not just the bond and equity markets where we've seen these attempted breakouts. We've also seen it in currency markets with the pound trying to push above the key $1.27 level. So a strong pound versus the dollar is usually negative for the Ftse 100. So when the pound strengthens against the dollar, you tend to see the Ftse 100 weaken, which we've seen this week. So the Ftse 100 is being a bit of a laggard in international equity markets. Also, a strong pound tends to be negative for your overseas US equity holdings. So it will be interesting to see if the pound breaks higher over the next week or so. Keep an eye on the exchange rate. Like I say, keep an eye on the $1.27 level. And if we break above that, it could very quickly head towards $1.30. Obviously, we are still in the midst of earnings season. So today we're going to get Microsoft and Tesla's earnings, and then tomorrow we're going to get Amazon's. So do expect a lot more volatility, particularly in those tech stock names. And then next week, obviously, we've got Facebook, Google, and Apple. So the next week or so is going to really test equity markets, and that spike in volatility that I've mentioned we've seen in tech stocks. It'll be interesting to see whether that now morphs and moves across into the wider indices. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com. You can contact me on Twitter, moneytothemasses with the number 2. Of course, you can join our Facebook group, facebook.com/groups/moneytothemasses. And you can find us on Instagram. And don't forget to subscribe to our YouTube channel.